Hello friends, on Wednesday, the 6th of July, the RBI, in a surprise announcement, took the bears off guard. They announced a slew of measures, and in this video, I want to examine whether the bears are going to be caught off guard on their back foot, and is the RBI likely to trigger an upthrust in the market. I'm Vijay Bhambwani. I've been a trader since 1986, and through my videos, I want to help fellow traders trade better, earn higher profits, and get higher return on investment. Let's dive right in. In last week's video, I told you that July typically is a month that favors bulls, at least in the Indian context, since the year 2000. And the market roundup window on your screen tells you that it was the banking stocks and the bank Nifty that led the upthrust in the market. Look at how gold and silver have come down. That tells you that defensive buying was down and risk on, that means higher risk appetite for financial assets, was seen in the markets. Crude oil fell, which was another positive factor because we want oil prices to come down. That would take care of inflation to a very large extent. Unfortunately, gas remains up, and the US dollar index, the DXY, also gained a little under 1.7%. However, the markets preferred to shrug off the negativity thanks to the RBI's announcement, and we are going to see whether it's going to make a material difference. I've recorded a video on the absolute impact of the RBI announcements, the announcements themselves. It's there on my social media pages. Please feel free to connect and watch that video. My contact coordinates will come at the fag end of this video. The US dollar index rose 0.38%, which is okay. The bond yields were more or less stable at 7.40%, unchanged. And the NSE gained 3.15% in market capitalization. Now that is good news for the bulls because the rally was fairly broad-based. MWPL rose, which is along expected lines after expiry till the third week of the month. MWPL does tend to rise. What I'm seeing as a definitive positive is that the US broader markets have seen an upthrust. Now, it still remains in the realms of a relief rally, but the fact that US markets supported the bulls tells you that in emerging markets also there is possibly a likelihood of an upthrust. Let's now check the US headline indices, starting with the Dow Jones Industrial Average. The daily chart on your screen tells you that the death cross remains in place. The 50-day average is below the 200-day average. The price is below the average itself. And on Friday, what you are seeing is a doji, a long leg doji, where the open and the close is fairly close to each other, which means at higher levels there was a little bit of skepticism. But do remember that the Dow Jones is a very narrow index. Let's now take at the technology heavy NASDAQ. It's basically seen a rally on 4 out of 4 trading sessions last week, and the death cross in the NASDAQ also remains in place, but this index is closer to coming and testing its 50-day moving average as compared to the Dow Jones, which is why on my Telegram channel on Friday, I gave you a slight move about the information technology or IT stocks. It's because the NASDAQ is showing signs of relative strength that I think this strength could percolate down to the Indian markets as well. Now, the broadest index of them all, the S&P 500, here again, there's a death cross, but the index has gained on 3 out of 4 trading sessions and coming to test, not yet there, but coming towards its 50-day moving average to test it, which is where it can run into the first hurdle. So what we are clear about is that in the US market, there appears to be an attempt to go higher. So the RBI's move is likely to add to that bullishness, and therefore there is a slight skew or a slight tilt in favor of the bulls so far. Let's now see the market-wide position limits. This is the extent of limits that traders have utilized as compared to what SEBI allows. It keeps rising till the third week of any derivatives month, and then in the expiry week, it plummets, which is why you're seeing these deep declines every 4 weeks. Now, we are seeing the MWPL rising, which is along expected lines after expiry. What I want to see is whether the bulls, the two marshmallow bulls, people who trade take their positions to the next trading session or next trading week perhaps, are enhancing their footprint in the market by taking bigger exposure or not. Now, this is a metric that I update on my social media accounts every day. Do feel free to connect with me. My contact coordinates come at the fag end of this video. Now, let's take the week-on-week turnover of the index and the individual stock futures. Both are down. This is a slight concern, which means that marshmallow traders who don't roll over their positions, are a little skeptical about buying en masse in large numbers. As a matter of fact, the index futures turnover is actually at its 20-week low. That's what the chart is about. It's a weekly chart spanning 4.5 months. So it's basically a sign of concern, and this is something that I would advise you to monitor. Now let's take the prompt month, the current month, July month basis. What is the basis? It's the future or discount of the index over its spot. The higher the basis or higher the premium, the more is the risk appetite, at least in the beginning of the derivative cycle, because there's a longer amount of tenure left to play, and traders should hypothetically therefore be willing to pay a higher risk premium. But the Nifty risk premium remains fairly curtailed, which is a sign of concern. Week on week on Fridays, we've not seen a negative close for 1.5 months now, but it does not mean that you get careless. This is something that you need to continuously watch. The daily chart is something that I update on my social media accounts day on day, so do connect with me. The Bank Nifty's basis is also easing, but it remains in the positive, just like the Nifty 50. But this is something that I would have wanted to be higher. Basis in both the indices should have been higher. But let's move forward. I now come to the weekly figure of the advanced decline rate ratio, a pretty simple metric, number of shares advancing versus number of shares falling. If at all the market has to turn bull to bear or bear to bull, this is the first indicator that turns. It's a leading indicator along with the price. This was the first thing that will tell you that the markets are turning. For the third consecutive week, we are seeing that the advanced decline ratio has remained above 1, which means for every falling stock, there is a matching gaining stock. So remaining above 1 means the gainers are more. So we saw a ratio of 1.22 as compared to 1.11 in the prior week, which is good. If at all the rally is to sustain, I want A, the prices to go up, B, the volumes to go up, 3, the basis to go up, 4, the advanced decline ratio to go up. Now, let's keep watching this ratio, because this is again something that I update on my social media every day. Let's now take a look at the impetus chart. This is a weekly chart, 20-week look back period, and what you are seeing is what you saw even on the futures basis chart. The Nifty impetus is flat. It's flatlining, it's going sideways. So even though the market has risen on a week-on-week basis, the impetus chart is not really particularly impressed. The Bank Nifty's impetus for sure has risen. And both the impetus readings last week were in the lower end of the 20-week look-back period, which means I told you the impetus is likely to go up from the oversold level. The fact that the Bank Nifty's impetus has risen with the price tells you that there is more force in Bank Nifty's buying as compared to Nifty 50's buying. So if the Nifty was to go into inversion, which means the basis becomes negative, future trades at a discount, and the impetus also turns hostile, the bulls have a slight problem. So let's keep monitoring this as well. Now for the latest edition in our in-house indicators, the LWTD, the Lift Weight Thrust Drag Index. This is a weekly chart, 20-week look back bias. What we are seeing is that the index percentage gain or loss line is ended on Friday with a 0.54% gain, whereas the LWTD has sunk below zero. It was trading above zero, but just about there, as you would have seen from my social media accounts every day. It was just about above zero, and now on Friday it has plunged to below zero. This is a slight worry. This indicator has a very good track record of basically being a leading indicator, telling us in advance where the market might go. So obviously the weightage is higher for the price, lower for the LWTD indicator. So the price is upwards, but the LWTD pointing downwards tells me that there might be a slight drag effect on Monday at higher levels. There might be a little bit of profit taking. Am I talking about a bear market? Not at all. Look, the price is up, undeniably. So the LWTD pointing down tells me that at higher levels, you should expect profit taking. I take you to the footprint of the four categories of traders. I start with the FIIs, the foreign investment institutions. They've basically continued to remain a little more optimistic as they were last week, because their individual stock futures net long positions have gained on a week-on-week basis, whereas their index net short positions have come down slightly. Going to the DIIs, they've basically cut their stock futures shorts even more aggressively, and their index net short positions have increased. Now, why are they cutting their shorts in the index, in the stock futures, and raising it in the index? This is dynamic hedging. Do remember, the DIIs could be hedging by going short in the individual stock futures, whereas they are supporting the markets by buying in the delivery space. So don't go by the huge, humongous negative figure in individual stock futures shorts, because delivery based, they are long. Now, prop traders, extremely interesting. Brokers own trades. These guys know who's buying, selling, so they are next best to insiders. They are dumping their long positions. No question about it. Week on week, they are dumping their long positions. Where their index net shorts are concerned, they've never been this bearish in a 20-week period, as the chart tells you. Even where the stock long positions are concerned, they are towards the lower end of the 20-week range. So the prop guys are not buying too much into the optimism. Now let's take a look at the retail segment. These guys have been doing all the heavy lifting since April 2020. They've powered the up move, no questions about it. And they have taken their individual stock futures net long positions below the 1 million lot mark for the first time in many, many months. And the quantity that they are holding, the sheer magnitude of their holding, tells you that if these guys start unwinding, they can make a serious impact on the price. So their figure is something that we need to monitor extremely carefully on a day-on-day basis. Their stock futures is fine, but the index futures net long positions have also come down. So even on the headline indices, they are now cautious. They are unwinding their long positions. And I would have said last week that the positions were down because of expiry. But hey, the expiry is gone, done and dusted. And now, even in the next new series, if the positions are coming down, that means these guys are now exhausted of holding longs. Friends, the in-house indicators segment done, I now come to the bond market. Now, this is a market that I have been leading the space in the public domain by telling you, you should not ignore. And if you're trading the bank Nifty, this is a metric that you just cannot afford to even ignore. What we saw, after the RBI's announcement on Wednesday, and this is a daily chart, is you will see two green candles, that is Thursday and Friday. Bond yields actually went up. All right. Now, if bond yields have gone up, that tells you that bond prices have come down, which is why the yields are up. That lends pressure to the banking stocks and to the bank Nifty. Do remember what I told you in my last week's video? I told you that I do not see the bond yields falling below 7.20 to 7.25 band very easily. And even if it comes down, and I repeat what I said, it will be a photo opportunity. It will not be a reversal. It will be a photo op. It will kiss the distance and jump again. I did not even have any inkling that the RBI was going to make this announcement, though I've been warning my online family since months. Since months, I've been ahead of the market and telling you that changes are coming in the FCNR deposit rates, and the RBI could spring a rabbit out of its hat anytime, which happened exactly. Bond markets don't seem to be too gung-ho and too enthused by the move, which means the RBI might, as I've said in my video on Equity Masters YouTube channel, which I uploaded on my social media account, the RBI might have to sweeten the deal further, either increase the tenure of the exemptions that they've given, or maybe even increase the interest rates on FCNRB and NRE deposits, or third, maybe even sweeten the whole deal further by saying, okay, we are going to give you tax exemptions also. Maybe more than one of these factors. We don't know yet. I'm just conjecturing. But watch the bond markets very, very carefully. If you are even monitoring, I'm not saying trading, if you're even monitoring banking stocks and the bank Nifty, ignore the bond yields at your own risk. Don't take this lightly. Above 7.50, if the bond yields, the Indian 10-year benchmark bond yields remain above 7.50 sustainably, I would suspect that there would be profit taking, if not selling, on the banking space, the bank Nifty. And I myself continue to ladder in the sovereign category. If you wish to follow suit, I think that's a very sensible thing to do. Friends, the bond market done. I now come to the US dollar index, because for emerging markets, this is a very, very crucial metric. We are import dependent, and any and everything that we import becomes more expensive. The dollar is higher and it triggers imported inflation. The daily chart on your screen tells you that this index rose on 4 out of 5 trading sessions. I know the 4th of July was a holiday, but this is electronic traded, and therefore it's open on all 5 days a week. What we saw was gains on 4 out of 5 trading sessions, and the only bright spot for the emerging markets is that this index has shown near gravestone doji on Friday, which is an inverted hammer. I would have called it a hammer, but the real body is too small. It's too narrow. So the prices attempted to go up intraday, but closed in the lower end of the intraday range, close to the very opening levels. And that tells you that higher levels might encounter selling pressure. Now, if the US dollar index, the Dixie, remains weak next week or coming days, chances are emerging markets, including India, might see a relief rally. The price remains above its 25-day exponential moving average, which is a proxy for a month-long holding on cost of a bull. So the short-term outlook still remains positive for now. Turning to the weekly chart on your screen, there's a big power candle, a bullish power candle that tells you that the bulls really went gung-ho on this index and bought aggressively. The price remains above the 25-week exponential moving average, which tells you that even the medium-term outlook remains positive for now. Last week, I advocated a range between 106.80 on the upside and 103.45 on the downside, which was overcome on the upside because the high was 107.615. the bullishness in the US dollar index exceeded my calculations. In the coming week, I expect a range between 108.65 on the upside and 105.15 on the downside. Watch this metrics very carefully. Friend, the US dollar index done. I now come to the bank Nifty, which gained 4.72% on a week-on-week basis and outperformed the Nifty 50, as I told you. It rose on 4 out of 5 trading sessions, and the daily chart on your screen tells you that the bump and run reversal has basically seen a confirmation of the dotted downward sloping trend line being overcome. That's a bullish sign, which raises the probability of the index heading towards the thicker red trend line, which is close to 36,800 odd levels. The price is above its 25-day exponential moving average, which is a proxy for a month-long holding on cost of an average bull. So now the short-term traders are suddenly seeing their break-even cost coming, or maybe people who bought recently are even smelling minor profits. That could raise the probability, I'm saying probability, of traders postponing their selling. Now on Thursday, this index opened with a gap up. Not very difficult to guess why, because the RBI's announcement and there was expectation of dollar inflows coming in and the markets were gung-ho. We need to see whether follow-on buying is emerging to basically back up the bull's strength. The 8th March 2022 swing low remains defended, and that's not really a problem. Turning to the weekly chart for now, you are seeing a big power candle, a bullish power candle, and that tells you the extent of buying was pretty healthy in the week gone by. That is being reflected even by my in-house impetus indicator. The 25-week exponential moving average, which indicates a 6-month holding on cost of a bull, is sloping down but was tested last week. Now, if at all this is overcome, this could mean that the bulls, the buy and hold bulls, are putting up a fight and they're trying to revive prices. If that happens, that could also lead to what is known as a short squeeze. A short squeeze is when the bulls force the bears to cover their short positions, and the bulls are buying, the bears are buying. It results in an explosive up move. I've recorded a video about how bear market rallies are extremely powerful, and do watch that video. The hyperlink is in the comment and in the description below. So what I am watching is whether the 25-week exponential moving average is overcome sustainably and the previous swing high is also taken out, which would tell me that the bulls are now having a fighting chance of returning back in the driver's seat. In the week before last, this index was at number 6 on our in-house high beta list. Last week, it rose 2 notches. It closed at number 4 on the beta list, which is a slight challenge for a retail trader because statistical beta or pure price volatility on an intraday basis can be a challenge to a retail trader. So do monitor that. Last week, I advocated a range between 35,175 on the upside and 31,925 on the downside. Now here, it was overcome because the high was at 35,262, a mere 87-point overshoot of my target. Now, technically speaking, yes, my estimate was overcome, but by how much? By mere 87 points, which is a very tiny figure compared to the fact that you're talking of a security which is priced at 35,000 rupees. In the coming week, I expect a range between 36,750 on the upside and 33,500 on the downside. Friends, the Bank Nifty done. I now come to the Nifty 50, which rose 2.97% on a week-on-week basis and rose on 4 out of 5 trading sessions last week. what we saw was the gap that you're seeing on your daily chart, which I had advocated last week as a primary hurdle to the bull, finally being closed on Friday. The 8th March low, swing low, which was violated earlier, did not really get tested again, so that's fine. As compared to the Bank Nifty, the Nifty broke that 8 March low, which is fine, but now that gap is closed. I told you on my Telegram channel that once the gap is closed, close to the gap at 16,200 odd levels, I expect statistical beta to shoot up. Volatility, a tug of war between bulls and bears. And there you see it. Although we've logged a bullish candle on Friday, it's way below the opening level. So there was a little bit of pressure at higher levels. That said, the price is above its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So the recent buyers are now getting hope of getting their money back. And the immediately recent buyers last week or maybe 10 days ago are now smelling profits. So higher levels may not see as much of overhead supply. Remember the concept I told you, when you're trapped at higher levels in long positions, market collapses, which it did because of a downward gap. Once the price starts to come up, panic-driven, weaker hands start to offload stock at their break-even points, and therefore the rally gets hindrances. That is going to be far less in the week ahead because you've closed the gap. The price is above its 25-day exponential moving average, and the previous swing high of 16,794, as you can see on your screen, is the first hurdle, the major hurdle for the bulls to basically pass another litmus test for themselves. Coming now to the weekly chart on your screen, you're seeing that it was a power bullish candle. The candle was seriously sizable in size, and the gap having closed, the price still remains below its 25-week exponential moving average, which is a 6-month holding on cost of a buyer. So here, compared to the Bank Nifty, the Nifty is still below the 6-month holding on cost, which is why it is lagging as compared to the Bank Nifty. Bank Nifty's impetus is higher, Bank Nifty's percentage gain is higher. The broader base Nifty is actually acting a little sluggish compared to the Bank Nifty. So this is one factor that I will be monitoring. That said, we basically need to see whether the 16,794, give or take a little bit with for emotional turbulence, is even tested in the coming days. That will be a very interesting thing to watch. In the week before last, this index was number 11 on our in-house statistical beta list. It fell 2 notches to number 13, which is a good thing because a heavyweight index like the Nifty being too high in statistical beta or sheer pure price volatility intraday raises challenges for intraday traders. And do remember that it was the Bank Nifty that saw most of the action, which is why the Nifty's statistical beta actually eased a little bit. Last week, I advocated a range between 16,375 on the upside and 15,125 on the downside, which held perfectly well in spite of all that volatility. And our estimates as per the in-house statistical model, the IBEX, held wonderfully. In the coming week, I expect an estimated range between 16,850 on the upside and 15,600 on the downside. So the sum and substance of these studies is that the RBI's move does seem to have imbibed certain amount of optimism in the market. That is undeniably so. But we need some more follow-up action on the Nifty. Banking stocks have seen enthusiasm. We'll still need some more buying, aggressive buying from the bulls on the broader base Nifty before the move can get accelerated again. But undeniably, the dice is somewhat tilted in the favor of bulls for the coming week. Friends, I would still suggest on a conservative basis to trade light. Don't get too aggressive and leverage too much because this market is fairly nervous and volatility can be high, especially for those traders who are rolling their trades over to the next trading session. Friends, all our indicators done. I now come to the latest indicator that I have added to this video, the percentage of turnover that options are logging as a component of the entire F&O turnover vis-a-vis futures. The chart that you're seeing on your screen is frankly worrying me. I'm seeing options turnover going through the roof, which means retail traders are buying. There's no doubt about the fact that they are optimistic, they are bullish, they are buying, but they are buying in relatively lower risk options route. They are not taking their clothes off and diving into the pool. They are getting their feet and toes wet first. They are seeing what's happening out there. We would have ideally wanted a lot more participation in the futures. Do remember the advanced decline ratio is barely above 1 and the impetus of the Nifty is still cautious. So we need this metric to go up a little more higher. Friends, the study is done. Now I come to the most popular segment of this video wherein I give you 5 impetus gaining stocks for Monday and 5 impetus losing stocks. The gainers, you will take small exposure, wait for large price moves. The impetus losers, you will take big exposure, wait for small price moves. This is good for scalpers, different traders, different strategies. So, hey, different techniques. So, the impetus gainers list is led by Aditya Birla Capital, number 2 Idea, number 3 Aditya Birla Fashion, number 4 Bhel, number 5 Aarti Industries. The impetus losers list is led by Zydus Life at number 1, Page Industries number 2, number 3 Shree Cements, number 4 Ultratech Cement and number 5 Whirlpool Industries. Friends, I now come to the end of this video, not before reminding you to click like on this video if you liked what you saw, subscribe to my YouTube channel if you haven't already done so. Good, bad or ugly, I always look forward to your feedback in the comments segment and click on the bell icon to receive instant alerts about fresh videos being put about here. Help me reach out to fellow like-minded, smart investors like yourselves by referring my video to your family and friends. Thank you for your patience. Thank you for being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.